Welcome to the Deep Dive. Today we are digging into Klarna, ticker KLAR, and what has to be one of the most confusing earnings reports I've seen in a while.
It's a really strange one. We had to cover this because you just don't see a disconnect this big very often.
Right. On one hand, you have management on the call saying it was their strongest quarter ever.
And on the other, you have the market handing the stock its biggest single-day shellacking since it went public.
So our mission today is to figure out what is going on. Why is management so bullish while the street is, well, so incredibly bearish?
Let's start with the good news because there was a lot of it. The top line.
The top line was great. Revenue came in at $903 million, which, comfortably beat the consensus of around $886 million.
That's 26% growth year over year, and gross merchandise volume, GMV, was also up 23% to almost $33 billion.
So people are using the product. The core business, the engine, is humming along just fine.
It is. The machine is running fast. The problem seems to be what kind of oil they're putting in it. And that's where we get to profitability, and the accounting gets a little tricky.
Yeah, I saw two very different EPS numbers. First, you have the official GAAP number, which was a miss, a loss of $0.25 per share.
A slight miss, yeah. But then you have the company's preferred number, the non-GAAP or normalized EPS.
And that was a huge beat, a loss of only 7 cents versus what the street expected, which was a loss of 26 cents.
Exactly. And normally a beat of that size would have sent the stock flying. But investors, they just ignored it.
They focused on one thing.
One thing, the statutory net result. Klarna swung from a $12 million profit a year ago back to a $95 million loss this quarter.
And that's what drove the sell-off. The volume on the stock just exploded that day.
It doubled. So the story the market heard was, growth is great, but the profits just evaporated.
Okay, so let's trace that profit evaporation back to its source, because management was actually very clear about where the money is going.
They were. It's all about the U.S. They hammered this point home again and again on the call. The U.S. is the growth engine.
The numbers are pretty staggering. U.S. GMV grew 43%.
And U.S. revenue growth actually accelerated to 51% year over year. It's not just a growth driver, it's the driver.
And this huge push in the U.S. is changing the kinds of products people are using, which brings us right to the heart of this whole P&L conflict.
It does. It's all about their longer-term interest-bearing loan product called fair financing.
This one product is the reason for the net loss. And that sudden drop in transaction margin dollars, or TMD, which came in at $281 million.
Exactly. And we should probably pause on TMD because it's a really important metric here.
Yeah, let's break that down. In simple terms, what is transaction margin dollars?
Think of it as gross profit after you take out the biggest risk. It's the revenue from all the transactions minus the direct costs, and most importantly, minus the money they have to set aside for potential credit losses.
So it's basically a measure of how healthy the actual loan book is before you even get to things like marketing or R&D spending.
You got it. It's a core profitability metric for them.
And if that number plummeted, it means that provision for credit losses just ate up a massive chunk of their revenue.
It did. The provision climbed to 0.72% of GMV.
Wow.
Yeah, up from 0.46% just a year ago. It's a huge jump. But management's argument is that this is basically just accounting noise.
A timing issue, right? Because with these longer-term fair financing loans, the accounting rules say you have to book the entire expected loss for the life of the loan on day one.
Instantly. You take all the pain up front, the market sees that cost and panics.
But the revenue from that loan, the interest income, that only trickles in over the next, year or two.
That's the whole paradox. Management was basically shouting from the rooftops that they are leaning into their most profitable long-term product, but it makes the P&L look terrible in the short term.
Yeah, they had a proof point for this, didn't they? The actual realized losses.
Right. The loans that are actually going bad and being written off, that number actually improved slightly, down to 0.44% of GMV.
So let me get this straight. Actual credit risk is going down, but the provision for future risk is going up, just because they're selling more of a certain product.
That's the story they're telling. Now, you can see why the market is skeptical. A jump from 0.46 to 0.72 is still a big number, regardless of the reason.
It is a fair point. But Klarna's counter is that the long-term economics are just too good to ignore.
They said the margins on fair financing over the life of the loan are over twice the group average. So they are swapping a temporary paper loss for very real, very high margin future revenue.
And if you're scaling a product that is literally twice as profitable as your average business, then yeah, maybe the upfront accounting pain is worth it.
Assuming they execute. And all the signs on the product side suggest they are. The whole pivot beyond simple buy now, pay later is happening fast.
I mean, the Klarna Card numbers were wild. 4 million signups in 4 months.
Blistering speed, and it already accounts for something like 15% of transactions in October. People clearly want it.
It just confirms their whole strategic shift. They don't want to be a BNPL feature. They're building a full-stack digital bank, a neobank.
You want to own the whole financial relationship, but what's really, truly staggering is how they're doing it. The efficiency gains they're almost unbelievable, and it's all about AI.
The numbers are historic. I had to read them twice. Since 2022, revenue is up about 108%.
And in that same period, operating expenses are up only 2%.
That is insane leverage. It's allowed them to triple their revenue per employee to about $1.1 million.
$1 million in revenue per employee. That's a software company metric, not a bank metric.
So how much of that is really from AI?
They were specific. Their AI assistant has automated the work equivalent of 853 full-time employees.
Which saves them, what, $60 million a year?
$60 million. So it's not a small improvement. It's a fundamental change to their cost structure.
And they did something really interesting with those savings and the people who were still there.
I thought this was fascinating. They cut headcount by about 47%, mostly through attrition, but at the same time, they jacked up the average employee's pay.
From, what, $126,000 to over $200,000?
To $203,000. Their argument is they're creating a smaller, elite, highly paid workforce that's aligned with the massive productivity gains from the AI. Pay for results, not for hours.
It's a bold strategy for managing AI disruption. Okay, so this super efficient neobank model,
Yeah.
how does it actually make more money per customer?
It's all about ARPAC, average revenue per active customer. They laid out a really clear ladder.
So your basic user, someone who just uses Klarna to pay for something once in a while.
That person is worth about $28 in revenue.
But if you can get them to download the app and start using the shopping features,
That number jumps to $90. The user becomes much more engaged, much stickier.
and the ultimate prize is the card user.
The Klarna Card user is worth $130 in ARPAC, over 4 times the average user. So their entire strategy is to push those 4 million new cardholders up that value chain.
To do that, though, they need to be accepted everywhere. And their strategy here is also pretty clever. They aren't trying to sign up every coffee shop one by one.
No, that's the old way. They want to be a default option like Visa. So they're partnering with the big payment service providers, the PSPs.
Companies like Stripe, WorldPay, Clover.
Exactly. The companies that already process payments for millions of merchants. Klarna integrates with them once, and suddenly they're available as an option to a huge network of businesses.
It's just a much more efficient way to scale. Okay, so all of this, the AI, the US growth, the cart, it's all building towards one thing.
Proving the profit story is real. And that brings us to the Q4 guidance.
This is the big one. This is the catalyst that proves management right or wrong about the Q3 profit dip being just, noise.
And the guidance they gave was extremely strong. They guided Q4 revenue higher than consensus to between $1,065 and $1,080 million.
But that's not the number that really matters, is it? It's the transaction margin in dollars, the TMD.
That's the number that directly answers the question about the fair financing provisions.
And what did they guide for TMD?
They are forecasting Q4 TMD to come in between $390 and $400 million.
Wow. Okay, so they just reported $881 million in Q3. They're guiding to a sequential jump of over $100 million in a single quarter.
A massive jump. If they hit that number, it completely validates their story that the Q3 problem was just timing. It proves the underlying business is incredibly profitable.
It's the moment of truth. And to make sure they can fund this growth, they announced a huge structural deal as well.
This $6.5 billion forward flow agreement with Elliott Investment Management, this is a game changer for their model.
Explain that. Why is a deal like this so important? It's not just about the money.
It completely changes how they approach lending. Right now, when Klarna makes a fair financing loan, they have to put it on their own balance sheet, take that upfront provision hit. With this Elliott deal, Klarna still originates the loan, but they can immediately sell the receivable, the risk, and the capital requirement to Elliott.
So Elliott provides the funding, Elliott takes the balance sheet risk, and Klarna gets its capital back immediately, plus fees for originating and servicing. It lets them grow their best product.
Without the capital burden and without the messy accounting, it makes their growth engine capital light. They're planning to sell $1.2 billion in receivables in Q4 alone under this deal.
It's like an insurance policy against another quarter like this one. Now, we should add some context here. The sell-off didn't happen in a vacuum.
That's a crucial point. The whole fintech sector was getting hammered. The fintech IPO index fell over 6% that week.
You had high funding costs, regulators circling BNPL everywhere, and just a general risk-off mood in tech. It was a sell first, ask questions later environment.
And right now, investors just want to see simple, durable profitability. They're not in the mood for a complex story about future lifetime value versus current accounting rules.
And that tension, that disconnect between the fundamentals and the market's mood is what makes our next segment so interesting.
All right, time for our This Is Not Financial Advice segment, and we have to start with a disclaimer.
We absolutely do. This is purely for educational and entertainment purposes. It's a thought experiment. We are not financial advisors, so please do not act on this.
Okay, with that out of the way, the premise of the trade is pretty simple. The market absolutely panicked over the accounting optics of that $95 million loss.
While totally ignoring, three massive compounding positives, the 51% U.S. growth, the fact that actual credit losses are improving, and that revolutionary AI efficiency.
You've got this deeply depressed stock with a huge binary catalyst sitting just a few weeks away in the form of the Q4 earnings report. Implied volatility on the options has spiked because nobody can agree on what's going to happen.
But management literally gave us the tell. They gave us the number to watch that will prove their narrative.
That TMD guide of $390 to $400 million, if they hit it, the story is validated.
So the outrageous but plausible trade is a leveraged bet on them hitting that number. You could look at something like a deep out-of-the-money call option, maybe 6 months out.
It's a pure bet that the stock re-rates, and re-rates violently, once Q4 confirms that the TMD ramp is real.
If they prove that the fair financing profitability is structural and the AI leverage is real, you could easily see the stock jump 30% or more back towards its post-IPO highs. It's a high-risk bet that management is telling the truth.
It's a bet on execution and a bet that eventually the market will care more about future profits than temporary accounting rules.
So, to wrap it all up, the core tension this quarter is that you have a company delivering explosive growth and almost unbelievable efficiency.
Hitting $1.1 million in revenue per employee.
And yet it's being harshly punished because of accounting rules tied to what they say is their single most profitable long-term product.
Which leaves us with a final provocative thought for you to chew on. If the AI automation continues on this path, making Klarna structurally leaner every single quarter, and if their neobank strategy really does generate 4 times the revenue per customer, is the market fundamentally mispricing Klarna's entire future as an AI-powered bank, all based on one quarter's temporary accounting noise?
Is the long-term margin story worth the short-term pain? A fascinating question. Thanks for joining us for this deep dive. We'll catch you on the next one.